Navigating turbulent waters. The impact of currency devaluation on international investment portfolios. In the vast expanse of international finance, the phenomenon of currency devaluation emerges as a powerful force, capable of reshaping the contours of investment portfolios and influencing the fortunes of investors across borders. To comprehend the intricate dynamics at play, one must delve into the multifaceted impact of currency devaluation on international investment portfolios. Understanding the nuanced ways in which exchange rate fluctuations can alter risk profiles, returns, and strategic investment decisions. Currency devaluation demystified. At its core, currency devaluation refers to a deliberate reduction in the value of a country's currency relative to other currencies. Governments may opt for devaluation as a policy tool to enhance export competitiveness, stimulate economic growth, or alleviate trade imbalances. While this maneuver can have domestic economic implications, its repercussions reverberate globally, particularly for investors with exposure to international markets. Exchange rates as performance indicators. The heartbeat of currency devaluation's impact on international investment portfolios lies in exchange rates. As a currency loses value, the exchange rate adjusts accordingly, influencing the returns of foreign investments when translated back into the investor's home currency. For instance, consider an investor with holdings in a foreign market where the local currency depreciates by 20% against the investor's home currency. Even if the foreign investment generates a positive return in its local currency, the overall return for the investor could be diminished when converted back into the depreciated home currency. Risk and reward in a devalued landscape. Currency devaluation introduces an additional layer of risk and reward into the calculus of international investing. On the one hand, investors stand to gain when holding assets in countries experiencing currency appreciation, as the returns are magnified when translated into a stronger home currency. Conversely, investments in countries undergoing currency devaluation may see diminished returns when repatriated. To illustrate, consider two identical investments in different countries, each yielding a 10% return in their respective local currencies. If one of these countries undergoes currency devaluation, the investor holding assets in that country might experience a lower overall return when translated into their home currency, even though the investment itself performed well locally. Impact on diversification strategies. Diversification, a cornerstone of prudent investment strategies, is significantly influenced by currency movements. Investors often allocate funds across various asset classes and geographic regions to mitigate risks associated with economic fluctuations. However, the impact of currency devaluation introduces an additional layer of complexity to this strategy. For instance, if a portfolio is heavily weighted towards assets denominated in a currency that undergoes devaluation, the overall portfolio return may be tempered. Investors must consider not only the performance of individual assets but also the currency dynamics that can either enhance or detract from the portfolio's overall return. Interest rate differentials and carry trade strategies. Currency devaluation is intimately linked to interest rate differentials between countries. In pursuit of higher yields, investors may engage in carry trade strategies, where they borrow in a low interest rate currency to invest in a higher yielding currency. While potentially lucrative, this strategy exposes investors to currency risk. If the higher-yielding currency experiences devaluation, the gains from interest differentials may be offset by currency losses. To illustrate, imagine an investor borrowing in a low interest rate currency to invest in a higher yielding currency. If the higher yielding currency undergoes devaluation, the returns may not be sufficient to cover the losses incurred when repaying the borrowed funds in the depreciated currency. Global economic dynamics and emerging markets, ***. Currency devaluation can be particularly pronounced in emerging markets, where economic conditions are often more volatile. Investors seeking opportunities in these markets must carefully navigate the associated currency risks. While the potential for high returns exists, the impact of currency devaluation can erode gains, underscoring the importance of thorough risk assessment and due diligence. For example, if an investor holds assets in an emerging market where the local currency experiences a sharp devaluation, the attractiveness of the investment may diminish, even if the underlying fundamentals of the asset remain strong. Hedging strategies and risk mitigation, ***. In the face of currency devaluation risks, investors may employ hedging strategies to mitigate the impact on international investment portfolios. Currency hedging involves using financial instruments, such as forward contracts or options, to offset potential losses resulting from adverse exchange rate movements. While hedging can provide a measure of protection, it comes with associated costs and requires careful consideration of market conditions and investor risk tolerance. In conclusion, the impact of currency devaluation on international investment portfolios is a multifaceted landscape that demands astute observation and strategic decision-making. Investors must be attuned to global economic dynamics, exchange rate fluctuations, and the interplay between currencies and asset classes. As the winds of currency markets continue to shift, the wise investor navigates these turbulent waters with a nuanced understanding of the risks and opportunities inherent in the world of international finance, ensuring a resilient and well-informed approach to global investment portfolios.